Okay, today I wanted to talk a little bit about active management versus passive management. It is a topic that's been covered quite extensively, but still to date, retail investors are only really about 10% of retail funds are invested passively, despite all the evidence that passive is a better way of investing. So I'm just going to go over some of the facts and figures. I'm also going to try and put passive into context a little bit more. I think passive really isn't quite the right name for it. There's still active decisions in there, so I'm going to touch on that as well. So firstly, like I said, I think passive really is just the wrong name. Passive makes it sound that it's somehow inferior. You know, would you really want to be known as passive? Would you want to be known to your wife, or would you want your colleagues to speak of you and say, yeah, he's a really passive guy? I mean, active just sounds more macho and more manly, and it sounds more proactive, and it sounds like we're actually doing something. And passive really just, you know, it sounds sort of flat and dull and a little bit inferior. I think the same sort of thing applies to some of the labels we put on the investment strategies as well. So, you know, which sounds more exciting, asset allocation or stock picking? You know, asset allocation sounds like some sort of dry, academic, abstract concept, but stock picking, that's something people can kind of get to grips with. That's what the man on the street certainly imagines that investing is all about: researching companies, finding undervalued companies, buying and selling. It sort of conjures up images that are sort of somewhere between Michael Douglas in Wall Street and the open outcry trading on the stock exchange that we used to have. So, you know, it's another term that actually sounds a lot more interesting than the boring and academic asset allocation. However, despite sounding sort of academic and dull and inferior, the evidence actually states that passive investing is much more effective. There have been a lot of studies that suggest that something like 90% of returns are attributable to asset allocation. It's something like 5% can be attributed to stock picking and 2% to market timing. So it's much more important to be in the right assets at the right time. Even if you're in the wrong stocks, but in the right sector, that's much more important. So asset allocation accounts for something like 90% of the returns that you achieve. And active management generally isn't very effective. In the US, where we have the most data for, over 20 years, something like 80% of active mutual funds underperform their benchmark. The figures are very similar for 10 and 5-year periods, and the figures are very similar in the UK. It's something like 70% of active funds in the UK underperform their benchmarks over a 15-year period, something like 75 over 10 years, and slightly higher again over a 5-year period. Of course, the other big issue, and one of the big reasons for the underperformance of active funds, is down to costs. It's much more expensive to run an active fund than a passive fund. And those costs really count. In this table you can see here, they're the value weighted expense ratios for active and passive funds in each of those sectors, as at the 31st of December 2012. And what you can see quite clearly is active funds are something like twice as expensive as passive funds. So there's a big difference in the cost. And of course those costs are much more significant when they're compounded over time. So this table we're looking at here, it shows it quite clearly. It's looking at £1,000 invested. It's going to earn 6% a year, and that 6% is going to be reinvested. And really the information we're interested in is on the right hand side after 40 years, so a particularly long investment period. But what you can see is if you have no charge at all, no management charge at all, after 40 years you'll turn your £1,000 into just over £10,200. If you were to have a 50 basis point charge, which is similar to the passive costs, after 40 years you would have paid £678 in charges, and because you can't reinvest that, you would have had lost investment income of £1,191. So instead of turning your £1,000 into over 10,000, you'd actually finish with 8,417, which is 18% lower. However, if you had a 1.5%, 150 basis point cost, which is closer to the costs we were looking at on the active funds, after 40 years you'd have paid 1,571 in charges. Your lost investment income would be just over £3,000, and instead of finishing with over £10,000, your final pot, your £1,000, would have been turned into 5,619. So it's a 45% deficit on what you'd get if you had no charges at all, and it's actually, you've lost about a quarter of what you would have got if you'd been investing passively with the 50 basis point charge. So it's a very significant cost, particularly if you think of it in terms of pensions and what you're going to do with that money. If what you're going to do with your pot after the end of your accumulation period is buy an annuity, which is then going to give you an ongoing income for another 20 or even 30 years, a 25% difference between what you would have in your final pots between investing passively or investing actively, that's going to have a really significant really significant impact on how much income you're going to take in retirement. So it can be life-changing. So it is very important. The other key point here is costs are something that we can control. When it comes to investing, there are many, many variables that we can't control. We don't know what's going to happen to inflation, we don't know what's going to happen to interest rates, we don't know what sort of level of return we're going to get from investments, but we can control our costs. So that's why I think it really is important to strongly consider investing passively, because it does help us control that one controllable, our costs. Finally, I wanted to talk a little bit about how passive is actually, I said at the start it's the wrong term and I was kind of making a joke of it, but it's actually right. If you are investing passively, you are still making important decisions. You're making decisions about asset allocation, whether you want to be over or underweight in the equity portion of your portfolio, over or underweight in the fixed income portion of your portfolio, whether you want to overweight emerging markets because you think they're going to give you an extra return, or underweight emerging markets because you think they're too risky. There's a whole series of decisions that you need to make regarding asset allocation. So it isn't actually passive in the sense that there's nothing for you to do or nothing for you to think about. All it means is you're taking out one layer of decision making, which is stock selection. So I think that there is an active decision making process going in to this kind of investment. So passive really is actually the wrong term. So in conclusion, I think our kind of fetish for active management is understandable. We're naturally kind of wired up to think that being active is something better than being passive and just letting things happen. But actually, like I said, passive investing isn't really a passive thing. You're actively making decisions about your asset allocation. You're just choosing not to get involved in the stock selection process. And all of the evidence suggests that that's a very wise decision, that by controlling your costs and investing passively, you're much likely to perform better over the long term. So keep your costs low, concentrate on asset allocation. That seems to be the best long-term strategy. If you're interested in finding more about passive investing, asset allocation, or if you're interested in the model portfolio service we provide, which is an asset allocation strategy that IFAs can insource at a very low cost with a very good performance track record. If any of that's of interest to you, just get in touch with us via our website.